Hello and welcome to Head On with Minaz Merchant, our current affairs show that puts the facts first and the narrative next. Today we're going to talk about the Reserve Bank of India and the transfer, a controversial transfer of 1.76 lakh crores to the central government. What does that entail? Is there a story behind that transfer? The finance minister wants to boost the economy, reflate the economy, increase demand, increase supply. Now, how are we going to find the funding for that? Is this 1.76 lakh crore the silver bullet, or do we need to look elsewhere? And where would this money go in terms of infrastructure, in terms of the banking sector, and so on? So all of that in a moment. Right, welcome back. So the Finance Minister Nirmala Sitharaman, 1.76 lakh crore transferred from the Reserve Bank of India to the central government. Rahul Gandhi says that's stealing money from the RBI. Now, that's complete rubbish because the government owns the RBI. You can't steal money from yourself. That apart, there is a thing called the CRB. The CRB, which is basically the contingency risk buffer. Now the CRB has not been reached because there's a band between 5.5% and 6.5%. Normally you tend to be in the middle of that band. On this particular occasion, the RBI, the panel set up under Bimal Jalan, the former RBI governor, has decided to keep it at 5.5%, and that is the mathematics of the transfer of 1.76 lakh crore to the central government. So we've got to make sure that we understand the arithmetic, and Rahul Gandhi's comment about stealing from the RBI. RBI is owned by the government, so there's no question of that. But is this 1.76 lakh crore going to be enough, even if the CRB 5.5% is maintained? Now, there has to be much more than this, because we've got to keep in mind that this 1.76 lakh crore rupees being transferred is not the net amount, because in the budget there was already a 90,000 crore apportioned from the RBI, the transfer from the RBI, and another 28,000 crore interim dividend had already been paid by the RBI to the government in February. So the actual extra non-budgeted amount that the centre has received from the RBI is 58,000 crore rupees, not 1.76 lakh crore rupees. That's not enough to boost the economy in any realistic way. So we've got to look at other avenues. There are two that we should be looking at straight away. The first of these two is privatization. The total value of the PSUs, 85 PSUs listed on the stock exchange, is about 18.5 lakh crore rupees. Now there's already a budget which has been put into place in the last budget of divesting about 90,000 crores, or maybe 100,000 crores. Last time's budget was about 90,000 crores. This is slightly more than 100,000 crores. But if we divest 15% of that 18 lakh crore, which is the total value on the stock market, that's about 2.70 lakh crore rupees. And that's a good 1.5 lakh crore more than what's been already budgeted. So that is the first of the other resources that we should be looking at. And the second, of course, is the sovereign bond. Now, a lot of people say, oh, we don't need the sovereign bond anymore because of this RBI transfer. Not true. The sovereign bond at very low international rates, 1%, 2%, 3%, good idea. We can raise $10 billion. It's something that the PMO will decide upon, but it is necessary, and that 70,000 crores will add again to the resources that we have to boost the economy, increase private investment, demand, supply, etc. We'll come to that in a moment. But the total arithmetic here is that off budget, which is not already budgeted, the total amount that we can raise, 58,000 crores from the RBI's transfer, not 1.76 lakh crores, because that includes stuff that's already been budgeted. So 58,000 crores there, 70,000 crores from the sovereign bond, and a net of 1.5 lakh crores from privatization, because about 1 lakh crores has already been budgeted and we have to divest about 2.7 lakh crores, or 15% of the value of the listed companies, PSUs, on the stock exchange. The total, therefore, 3 lakh crores. Now, the important point is, where will that 3 lakh crore go? Where can it be used most optimally? Because our problems are demand, supply, reflating the economy. Now, that is the question. 3 lakh crores, but where should we spend it? And there are 4 or 5 straightforward avenues. First, of course, is the banking sector, banking and financial sector. That should get approximately between 70 to 80,000 crore rupees. Then we have the housing sector, a major part of the economy. That again should get about 20 to 30,000 crores. Then this infrastructure, where the government has plans to, it's budgeted, but beyond, over and above that, new money should flow into infrastructure, and that should be in the region of another 1 lakh crore rupees. That takes us to a total of 2 lakh crores so far. Leaves 1 lakh crore of the net 3 lakh crores, which we still have in reserve, and that should indeed be the reserve for a variety of things. One, a shortfall in tax revenue as a cushion. Second, export incentives, and so on. So overall, the 3 lakh crores in banking, in housing, in infrastructure, and finally as a contingency reserve for the government. These are the areas in which we can best, most optimally use that extra money. We've seen the source of raising the revenue, the sovereign bond privatization, and of course the RBI transfer net 58,000 crores, not 1.76 lakh crores. So that's the net 3 lakh crores raised, and then the spend on the 4 basic sectors, or the 4 basic avenues: banking, and housing, infrastructure, and of course the contingency reserve, which can go into export incentives and so on. Right, so basically, having done this, demand, supply, private investment going up, because the more banks lend to corporates with the extra liquidity they've got, the more corporates can invest. Right now they are not investing. So overall supply will get boosted. Housing, the banking sector, infrastructure, all of that will create supply. But what about demand? For that, we need to look at the direct tax code, which is, the panel has submitted its report to the finance minister a week ago, and the direct tax code, essentially, it's not in the public domain, the exact recommendations, but we're moving towards a somewhat simplified flat tax regime. 10%, 20%, 30%, below 6 lakh taxable income, 6 lakh rupees taxable income, no income tax, exemptions either removed or cut out, dividend tax reform there as well. So once more money comes into the pockets of the middle class consumer, consumption will go up. There will be, first of all, more liquidity in the banking sector, as we saw earlier. That will help. The EMIs will go down because interest rates will be cut with the new monetary policy and with inflation low. But overall, if the direct tax code is implemented properly, then there will be more money in the hands of the middle class. So when we come back, we'll move into a different area, which is important, and that's structural reforms, which are important. While we do the micro and the macro, as we've just seen, it's important to do some important, really key structural reforms, but of that in a moment. Right, welcome back. One of the most important and controversial reforms that has been suggested, but has never been implemented because it's politically very difficult, and that is to tax agricultural income. Farmers are in distress, there's rural distress, but there is a good logic behind taxing the top 4.1%. And I'll tell you what 4.1% means. Of the total number of farmers in this country with agricultural holdings, if you take more than 10 acres holdings, only 4.1% of the total population of farmers which have more than 10 acres holding. They're the rich farmers. So should rich farmers be taxed? They've got an income much above that 6 lakh threshold limit that might or might not come into the direct tax code. But rich farmers, 10 acres plus holdings, taxable income well over 6 lakh rupees a year, much more, very often much more, into the tens of lakhs and even higher than that. If that 4.1% slice at the top is taxed, then the revenue potential is about 50,000 crore rupees. That again is another resource that can come into the revenue net. But that's a major policy decision which has to be taken, keeping in mind the political ramifications. Apart from that, structural reforms in land, the Land Acquisition Act, been moribund for more than 5 years. That's got to be revived so that land acquisition for infrastructure and other projects is hastened. Then labor reform, some movement in that has happened. Much more needs to be done so that hiring and retrenchment with compensation is made easier. And finally, foreign investment. Now, we've got this colonial hang-up that we shouldn't allow foreigners to come in. The left doesn't like it. The right doesn't like it. The RSS, for example, very much against foreign investment coming into India. The left, again, against foreign investment, left and right, on the same page as far as foreign investment is concerned. But during the colonial era, during the British occupation of India, brown, or rather Indian resources were used for foreign benefit. Now we have the opportunity of using foreign resources for Indian benefit in infrastructure, in civic projects, in all kinds of different activities. So we shouldn't shy away from opening the economy and having an open-minded attitude to foreign investment, whether it's in retail, or it's in digital media, or it's in other sectors across the board. So that, I think, foreign investment will once again be a major source of revenue. And the purpose of all of this, what the RBI has transferred, the sovereign bond, the privatization, putting the money into, as we said, the banking sector, the housing sector, infrastructure, and the reserve for exports and incentives and so on. All of that is aimed at just one thing: to reflate the economy, get demand up, to get supply up. Supply through the points that we mentioned, demand up through the direct tax code and many other reforms. So that then is the plan. I think we should go ahead with an open-minded approach and not over-regulate things. Now, we tend to over-regulate. Many of our regulatory authorities have tended to go from the license Raj to the regulation Raj. That should not be the way forward. So that's it for this episode. Thank you very much for watching. We will hope to see you next week. And once again, thank you and goodbye.